Hello everyone, today I'm going to share with you the 3 best Canadian equity ETFs for 2025. These ETFs must be traded on Toronto Stock Exchange and making them directly accessible for Canadian investors. A quick note before we jump in, these are equity ETFs, not fixed income ETFs, even though I know Canada has some of the most interesting cash ETFs, but today we're not going to cover that. It will be for a future video, so please don't forget to like and subscribe. And while the word best is very subjective, we are focusing funds that I think are the best for long-term investors. The first one I want to share with you are actually 2 ETFs that tracks the same index, which is the American S&P 500 index. So we have 2 excellent options right now in Canada. First, number one is Bank of Montreal BMO S&P 500 Index ETF. Ticker symbol is ZSP. And then we have Vanguard S&P 500 Index ETF with the ticker symbol VFV. So both are giants in Canadian ETF space. They're actually the top 2 largest ETFs in terms of asset under management. Both of them have over 16 billion asset under management, and they track the same index, right? S&P 500, which gives you the exposure of the 500 largest companies listed in the US. So why are these ETFs no-brainers for Canadian investors? Because Canada is the neighbor of the largest economy in the world, and investing in American stocks offer diversification and access to global market leaders. And cost-wise, these 2 options are equally appealing. Both have an annual management fee of 0.08%, so they're the same, and they're very, very low. Making them some of the most cost-efficient way to gain exposure to U.S. stock market. So one important concept we have to understand is currency hedging, okay? Because especially when you are buying Canadian ETFs that are listed in Canada using Canadian dollars, but those ETFs are invested into foreign assets like American companies, lots of those ETFs have currency hedging feature. Which means those ETF performance isn't impacted by the fluctuation of the exchange rate between the Canadian and US dollar. But for ZSP and VFV, neither of them have currency hedge. So they are not currency hedged. So they will be influenced by the exchange rate. While currency hedged ETFs, they achieve this by using derivatives to offset the effect of exchange rate movements. But of course, every time you touch those derivatives, that means it's not going to be 100% efficiency. That means there will be cost. There will be extra cost for this mechanism, meaning that you still will, even though in theory you won't get affected by exchange rate fluctuation, but your return won't be as high in terms of percentage-wise, won't be as high as the original American ETF that tracks the same index because of this inefficiency of the currency hedge. But good thing is the 2 ETF I just mentioned don't have this feature. But there are some differences between the 2 ETF. One noticeable distinction between these 2 are how they're achieving their exposure to S&P 500. So for ZSP, the one by BMO, they directly hold all 500 companies or 500 stocks in the S&P 500 index in their respective proportions. Okay, and for VFV, the one the Vanguard ETF, they hold the U.S. Vanguard S&P 500 ETF, the VOO. So it's this VFV, it's holding American ETF VOO. So effectively acting as a wrapper for the US-based ETF. So both method achieves the same goal. Now let's take a look at the performance and the return of the 2 ETFs. So both ETFs, they were launched in the same month, same year, November 2012, giving them a comparable track record. So over the past 5 years, as we can see, the performance has been very, very similar. But there's a slightly edge for VFV, because VFV, as we can see down here, the yellow line, of course, they're very overlapped. The yellow VFV is up 104% in the past 5 years. The Bank of Montreal ZSP was up 103%. So making VFV 1% superior in the past 5 years. Well, the difference between the two are very, very minimal, but VFV, because it historically delivered a marginally better return, that becomes my preferred ETF between the two. Now, number 2 on the list, we have, again, 2 ETFs that tracks the same index, which is the NASDAQ 100 index, right? This index is actually my favorite American index. It's one of the hottest sector, or it captures where the exposure of the index is at the hottest investment area right now. For example, right, currently the booming of AI is being heavily captured by NASDAQ 100. It's the 100 largest technology stocks in America. So for Canadian investors, there are 2 excellent options that's listed on Toronto Stock Exchange that give you exposure to this index. So number 1, we have QQC. It's called NASDAQ 100, Invesco NASDAQ 100 index. It's not currency hedged, okay? And this second one is from the same issuer, Invesco QQC.F. It's the Invesco NASDAQ 100 ETF, actually have the same name, but this one is currency hedged. Now, I made some change for the asset under management because this website wasn't updated, so I grabbed the most up-to-date number for the AUM. So in terms of AUM, QQC, the non-hedged version, have $708 million asset under management. QQC.F have $959 million asset under management. So in terms of management fee, both ETFs have the same management fee of 0.2%. It's these two are the lowest ETF in Canada in terms of fees for tracking NASDAQ 100 index. So let's compare the structure. So both of these ETFs have the same structure. Both are funds of funds, okay? Meaning that they both invest in the US listed NASDAQ 100 ETF issued by the same company, Invesco, because Invesco is the original company that issued the legendary QQQ ETF, okay? So these 2 funds, they are investing in either QQQ or QQQM. Okay, they're wrappers, essentially acting the same as a VFV, because Vanguard is also an American company. So let's compare the performance of the 2. Well, both ETF tracks the same index. Their performance, their returns are very different, significantly different due to the currency hedging mechanism. Okay, so here we're only comparing the 1-year return. It's because QQC is not 5-year-old yet. Okay, so if we look at in the past year, if we look at QQC, it's up 41.3%, while QQC.F, right, QQC.F, the one with the currency hedge, it's only up 29.4%. So where is the discrepancy come from? It comes down to the Canadian dollar's performance in the past year. In the past year, overall, the Canadian dollar weakened against American dollar or US dollar, boosting the value of the American stock asset that's being held in these ETFs in the QQC, right? QQC. Meanwhile, QQC.F, coming with that currency hedging mechanism, muted the impact. So its performance is actually very, very aligned with the actual performance you would get if you buy QQQ using American dollar, using US dollar, because QQQ 1-year return is 30.7, and if you look at QQC.F, we got just under 30%, right, 29.41%. And like I said, it's not perfect. This hedging mechanism is not 100% efficient. That's why it's lower than the actual QQQ. Now, the question is, what's my choice? What would I pick between the two? Okay, for long-term investor, I prefer QQC, the one with no currency hedging, because over the long term, currency fluctuation tends to balance out. And unless you're super sure Canadian dollar will go down in the future. But I don't think anyone is sure about that. Okay, because no one is sure about that, and because they balance out overall in the long term, the currency impact, this makes the cost of hedging unnecessary. Okay, unnecessary. It uses derivatives that cost money. The hedged ETF like the QQC are generally more cost effective and provide greater exposure to the potential upside of the US dollar relative to Canadian dollar, right? Because remember, these assets are American assets. And for Canadian people, most of them already own Canadian asset, like maybe you buy a house or whatever. But if you buy QQC, your asset will give you this sort of currency diversification. It's American asset, okay? And while currency hedging can be beneficial in short term for those who are concerned about exchange rate volatility, but for the long term, again, long-term investor, growth-focused strategy, I think QQC is a better choice. So coming up next, we have actual Canadian exposures, okay, actual real Canadian companies listed in Canada. And number one, we have iShares S&P TSX 60 Index ETF, ticker symbol XIU. And number two, we have iShares Core S&P TSX Capped Composite ETF, ticker symbol XIC. Third one, we have Vanguard FTSE Canada All Cap Index ETF, ticker symbol VCN. Now the key details of the three is they are all very large fund. Largest is the XIU with $14 billion, XIC $12.9 billion, VCN have $7.5 billion. Now in terms of management fee, XIU have an annual fee of 0.18%. It's the highest of the three. XIC have 0.06 and VCN 0.05. Of course, the Vanguard ETFs usually have the lowest fee. And in terms of the index being tracked, they are already suggested in their names, right? That's the three index that each of the ETF tracks. So the XIU, this S&P TSX 60, they represent the 60 largest companies in Canada by market capitalization. So this is like S&P 500, but only 60, the top 60. Now the XIC, this one, the S&P TSX Capped Composite Index, this one offer a broader exposure to about 200 Canadian companies, including all cap sizes, okay, large, mid, and small caps. And it's a capped ETF, meaning that no single company in the ETF can have more than 10% weighting, okay? And the third one, VCN. This FTSE Canada All Cap Index is similar to the XIC. It covers 162 companies across all market capitalization. Now let's compare the performance of the three. We have XIC here up 47.3%, XIU here 48.5%, VCN 48.9%. Okay, the returns for the past 5 years for all three are very, very similar. If we compare the dividend yield, the XIU have 2.5%, XIC have 2.9%, VCN have 2.5%. Okay, again, very similar. But if you compare it to the to VFV, the one that tracks S&P 500, that will only give you an annual dividend of 0.71% because in general, Canadian companies gives more dividend, okay? And while Canadian company, they do give more dividend, but the total return overall is still significantly lower than the US companies. Compared to VFV, okay, the total return is still a lot lower than VFV. Let's go over some of the considerations for these three ETFs. So if you do decide to invest in Canada, Canadian companies, all three of them are pretty solid, okay? It all comes down to your preference. Do you want more of a top 60 type of thing, or do you want a broader market exposure, okay? So the XIU focus on large cap, only the top 60. XIC and VCN is broader exposure, including mid and small cap companies. However, before you invest, consider the trade-offs, okay? Number one, it has lower returns, okay? Canadian equity returns lags behind US equities over time, looking at the history. Doesn't mean in the future Canadian won't outperform, but just looking at the history, US outperforms Canada, okay? And there's a good thing, which is higher dividends. Canadian company have better dividend yield, maybe appeal to income-focused investors. But even if you do include the dividend income, the total return still lags the American company, the American counterparts by a lot. Okay. Number 3 is diversification. If you do include Canadian companies into your overall portfolio, it does enhance your diversification compared to as if you only invest in American companies. Okay. So this may help you during the economic downturn or crisis. Okay. More diversified you are, the more defensive you become. Okay. So ultimately, it's about the balance between the return potential and diversification to fit your investment strategy. Thank you very much. Please don't forget to like and subscribe.